Most Indians work hard for money. Very few make money work for them. Salary comes in, bills go out, savings stay small. Years pass quietly, but wealth does not grow automatically. Here is the truth. Investing is not only for the rich, it is how ordinary income becomes extraordinary freedom. You do not need perfect timing. You need a clear roadmap. If you understand this today, you avoid costly mistakes tomorrow, and that changes everything. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Build financial safety. Before investing, create an emergency fund. Minimum 3 to 6 months of expenses. If you spend 30,000 rupees monthly, keep 1 to 2 lakhs aside in savings account or liquid fund. This protects you during job loss or crisis. Without this, you may sell investments at the worst time. Safety first, growth next. Step 2. Clear high-interest debt. Credit card interest can cross 30% yearly. No investment consistently beats that. Repaying such debt gives guaranteed return. Debt-free foundation creates stability. Step 3. Start simple with mutual funds. Do not begin with random stock picking. Choose index mutual funds, Nifty 50 or Sensex funds. You invest in top Indian companies together. Diversification becomes automatic. Low cost, high discipline. Step 4. Start SIP immediately. Systematic investment plan. Fixed amount every month, same date. Example, rupees 10,000 per month. At 12% annual average return, in 20 years, it can grow near 1 crore rupees. Time does the heavy work. Consistency matters more than amount. Step 5. Understand asset allocation. Do not put everything in equity. Example allocation. 70% equity mutual funds, 20% debt funds, 10% gold ETF. Allocation reduces volatility. It controls emotional decisions. Step 6. Understand risk cycles. Markets rise, markets fall. 10 to 15% correction is normal. 20 to 30% bear market happens. During crashes, continue CIP. Lower prices mean more units. Patience compounds. Fear destroys. Step 7. Rebalance yearly. Every 12 months, check your allocation. If equity becomes 80% instead of planned 70%, shift some to debt. If market falls sharply, rebalance into equity. This enforces discipline. Buy low, trim high, without guessing future. Step 8. Understand tax basics. Equity mutual funds held above 1 year, 10% tax on gains above 1 lakh rupees. Choose direct plans. Lower expense ratio improves returns. Small percentages matter long term. Step 9. Avoid common mistakes. Stopping SIP during correction. Switching funds frequently. Following social media tips blindly. Short-term returns are misleading. Follow system. Ignore noise. Step 10. Scale gradually. Start with rupees 5,000 or 10,000. After 6 months, increase by rupees 2,000 to 3,000. Every salary hike, increase CIP proportionally. Small increases multiply over decades. Income growth should reflect in investment growth. Step 11. Track intelligently. Do not check portfolio daily. Review quarterly. Ask one question. Am I following my plan consistently? Process builds wealth. Chasing monthly profit builds stress. Step 12. Long-term mindset. Investing is slow, sometimes boring, but over 15 to 20 years, it becomes powerful. Time in market matters more than timing the market. Discipline beats emotion. Identity matters. See yourself as a long-term investor, not a trader. You start small. You stay consistent. You increase gradually. You control risk. You ignore noise. Years pass. Your investments grow silently. One day, money works for you, not the other way around. Your future self will thank you because wealth was built patiently, through structure, through discipline, through time. Stay invested.